Welcome back. As discussed in the previous lesson, in this lesson, we will be going over transaction examples that happen with the 5 accounts. So I'm excited to start. Let's get right to it. So as we discussed in the previous lesson, an asset is any resources owned and or controlled by the business. So anything from cash on hand to inventory on hand that we are selling to our customers, to the accounts receivable account where we record transactions where we're owed money by our customers for the most part, and they'll be paying us back in the future. Vehicles, equipment, buildings, and even computers and desks fall into this category. So if assets are being gained, it's a debit, and if assets are being used, it's a credit. So bear with me. I know the rules are confusing in definition, but as we go over the examples, they'll get a lot clearer, and you will see the methodology about how we use these rules. So let's get right to it. So the first example of transactions with assets. So the business purchases $500,000 worth of office equipment, right? So we are debiting office equipment for $500,000. Now, why are we doing this? So office equipment is an assets account, and essentially $500,000 worth of office equipment, which is assets, are coming into the business. So that's what we're gaining. We're gaining the asset of office equipment. And to increase an asset account, which in this case is the office equipment account, we debit it. We debit this for $500,000. The next thing we do is we credit cash for $500,000. And the reason why we do this is because the business purchases, right? That's the key wording here in the example. So we purchased the equipment for $500,000, meaning assets are being used here, which are cash to purchase the office equipment. So cash is going out of our business to purchase something. So money is flowing out of our business in the form of cash. Cash is an asset, and since cash is being used to decrease an asset account, we credit it. So we credit cash for $500,000. Next example. The business gets a $30,000 loan from the bank. So we are debiting cash here for $30,000. And this is happening because the bank is giving us a loan, right? In the form of $30,000 cash. So we have $30,000 cash coming into our business, and it's gained, right? Assets over here are being gained in the form of cash. It's a loan, but it's still assets nonetheless that are being gained by the business. So we are debiting cash here for $30,000. Cash is an assets account. To increase an assets account, since it's being gained, we debit it. Now we credit the loans payable account for $30,000, right? So this isn't free money. We have to pay it back at a future date. So we have accumulated a liability here. So since this is a loan, we will be crediting the loans payable account for $30,000. And loans payable essentially is a liability. And since we've acquired a liability, to increase a liability, we credit it. That's why we credit loans payable for $30,000. Transactions with expenses. Now, expenses are costs incurred from business operations. So anything from phone bill expense, office supplies, advertising expense, all of these are expenses, right? Rent, utilities, travel, anything having to do with expenses, really, that are acquired when the business is running. So the first example is that the business spends $8,000 for rent expense. So no matter what business, I guess, or really just brick and mortar businesses, if you are running a business, you need a location to run the business. And with the location usually comes a rent expense. So we are debiting rent expense here for $8,000. We have essentially acquired an expense. And since rent expense is obviously an expense account, we have to record this as an expense that's coming into the business. So we debit rent expense for $8,000, and that increases the expense account. We credit the cash account because this is essentially what we're paying out, right? So we're paying cash. An asset is being used to pay the rent expense. In this case, it's cash. So cash is being used, and since cash is being used and it's an assets account, to decrease an assets account, we credit it. So we credit cash for $8,000. Next example, the business pays for $3,000 worth of office supplies on account for use. So now we are debiting office supplies expense for $3,000, right? We're recording an expense. Obviously, office supplies are coming into the business, but the moment they do come into the business, it's going to be immediately consumed. And because it's being consumed, right? Office supplies could be anything from pens, pencils, staplers, basically anything that helps the business function, right? That's why we record it as an expense more than an asset, perhaps. So since office supplies expense is obviously an expense account, we are increasing that in this transaction for $3,000. So that's why we debit it. And now we are crediting the accounts payable account for $3,000 as well. So it's not like we paid to purchase the office supplies, right? We promised to pay at a later date. So this is a liabilities that we acquired in the form of accounts payable. Accounts payable, we credit it to increase that account, right? Because we need to still fulfill those obligations of paying back for the office supplies. Transactions with liabilities. So liabilities is any value that the business owes. So accounts payable, meaning money that we owe to suppliers, vendors, or banks as well, right? We record the transaction in the accounts payable account if we owe money to somebody. So it could be anything from credit cards, loans, mortgages, payroll, etc. So to increase a liability, it's a credit, and to decrease it, it is a debit. So the business purchases inventory on account for $60,000. So what is being identified here is an inventory, right? So we are debiting inventory for $60,000. Why? Because inventory, which is an asset worth $60,000, is coming into the business. So we have gained an asset here. And since an asset is being gained in the form of inventory, we debit the inventory account, and that account increases. And now the next part is we credit the accounts payable account for $60,000. And the reason we do this is we haven't paid directly yet for the inventory, right? We will be paying back at a future date, but for now it's a liability we've accumulated and we are obligated to pay it back. But for now, we need to put it on the accounts payable account for $60,000. Since this is a liability, to increase a liabilities account, we credit it. So now the business pays off $30,000 loan from the bank. So this is the callback from the transactions with assets slide, right? So we've finally paid back the loan that we've acquired on that slide. So what we would do is we would debit the loans payable account for $30,000. That is a liability that is off our shoulders, so we don't need to worry about it. So to decrease a liabilities account, in this case, loans payable, we debit it. So that's going out. And we credit the cash account for $30,000, right? Since we paid it off, cash is being used, and since cash is being used, it's an assets account, And for assets accounts, to decrease them, we credit it. So we would decrease cash for $30,000. Or yes, we would decrease the cash for $30,000 and decrease it, we would credit the cash account. Transaction with revenues. So revenue is income from the goods and services sold by the business. So to increase the revenue, you credit it, and to decrease the revenue, you would debit it. So let's say you make a $10,000 sale on a car, for example, if you're a car dealership. So we debit cash for $10,000, right? That's $10,000 worth of cash coming into the business. We have gained an asset, which is cash. And to increase an asset, since it's been gained, we debit it. And the next thing we do is we credit sales revenue account for $10,000. So the cash that's coming in is also the result of a sale, right? So we identify it as a sales revenue as well. And to increase a credit account, which is what a revenue account is, we would increase it by crediting it. So the next example, the business provides $70,000 worth of services to a customer who has not paid yet. So we debit accounts receivable for $70,000, right? Since this customer hasn't paid us yet for the services that we have done for them. So they will pay us back at a later date, but for right now, it is an asset that is going into our accounts receivable account. It's been gained, right? Their obligation. So, or not their obligation, it could also be on credit, but essentially we are promised a payment in the future. So that goes into the accounts receivable for $70,000. So that increases since assets are increased by a debit account, and we credit service revenue for $70,000. So since we performed a service for them, we still identify it as service revenue on the day that it was performed and finished. So service revenues is obviously a revenue account, and to increase a revenues account, we credit it. So we credit service revenue for $70,000. Last but not least, transactions with equity. So as we discussed, equities is how much the business is worth. It's essentially the difference between your assets and liabilities. And if you don't understand this more in depth, don't worry about it. We will get into more of the semantics on the balance sheets portion of the lessons. But for now, examples of this are owner's equity, common stock, and retained earnings. So to increase equity, you would credit, and to decrease equity, you would debit the account. So the owner invests $40,000 in the business, right? So from the business perspective, the business is getting $40,000 in the form of cash, which is an asset that's being gained. And to increase an asset, we would debit it. So we had a debit cash here for $40,000. And we are also increasing owner's equity, right? Since cash and since assets as well as equity are proportional, essentially. So if assets goes up, then equity goes up as well. And we are crediting owner's equity for $40,000 since that is more money that is really coming into the business. And we would credit that for $40,000, and that would increase the owner's equity account. So that's part of the balance sheet portion a little bit, where if the assets increases, the equities portion also increases as long as the liabilities are low and they don't cut right into it. But it's a proportional relationship, and you'll see that on the balance sheet. So the next example, the owner withdraws $80,000 from the business. So now the owner is essentially taking away money from the business into maybe a personal account or what have you, right? So what happens is we debit the owner's equity account, right? The equity is not within the business anymore. So the business loses worth a little bit, and since it's losing from that account, the account decreases. So the decrease in equity account, we would debit it. So over here, we're debiting owner's equity for $80,000. And cash is going out of the business as well, right? Assets are going out in the form of cash. So we would credit cash for $80,000 because cash is going out of the business as well. So now that you've learned about transaction examples that happen within the 5 accounts, in the next lesson, we will be going over financial reports and other financial processes that are associated. So let's pause here. This is a good place to stop. We've gone over all 5 accounts. Thank you for watching, and see you in the next lesson.